What's up, everyone? Welcome back to another video. This is your host, Mr. Aslan. Crypto education is my passion, guys. I'm not a financial advisor, and this is definitely not financial advice. All those people who are thinking of providing liquidity or becoming liquidity providers in any of the liquidity farms available, you need to make note of this important concept called impermanent loss. So, what exactly is impermanent loss? How does it impact your liquidity pool earnings? These are the things that I'll go ahead and discuss in this video. I'll show you the exact calculation using certain examples to understand and make it simpler for you guys to know that this complex calculation of liquidity pool and the impermanent loss itself is something that you really should not take it easy, because unless you understand and calculate your impermanent loss in an approximate basis, there are chances that you might actually lose out a pretty big amount of money in whatever you have provided as liquidity. So let's head over to my Excel sheet wherein I show you some calculations and with examples. So here is the base calculation that I have done based on few examples that I have taken. So the price of these tokens, ETH and JED, that I've taken as an example are just indicative, just for keeping it simple for calculation as such. But let me tell you honestly, calculating liquidity pools and their actual ratio changes, it's very complex. However, I'll try to make it as easy as possible for you guys to understand. So let's assume you have one ETH and 100 JET tokens that you want to go ahead and provide for liquidity. And for simple calculation purposes, let's assume that ETH is at $100 and JET is at $1. Now, the value of your actual investment would be 100 and 100. That's a total of $200. So now that you have $200 that you're putting in to your actual liquidity pool, then the total liquidity pool that is already existing, assume that it has 10 ETH and 1,000 JET tokens already there. Now, since you're putting 1 ETH and 100 tokens, your contribution would be 10% of the entire liquidity pool. Now, how a liquidity pool operates is when you have the combination of two tokens in a pair, the price of both the tokens multiplied with each other should always remain a constant. Now, considering that, if you take the existing pool, dollar value, which is a constant, will be $10,000. Now, this should and will remain a constant always. That's the rule of a liquidity pool. So whenever there is a price change that ideally happens, then there is a change in the ratio of the tokens. There might be a difference in terms of the amount of ETH or the amount of JED compensate the price variation that's occurring in the market. Consider the scenario where ETH actually raises to $400 from its initial value of $100. Now, one ETH would be equivalent to 400 JED tokens, considering that JED still remains at a dollar value level. Now is where the pool adjustment starts happening, either through arbitrage traders or through automated market makers. In the background, whenever there's a request for swap, or people who are arbitrage traders well aware about how the liquidity pools work, they start trading and swapping JET tokens to get ETH, which is below that $400 value existing still in the liquidity pool, until this particular liquidity pool ratio adjustment comes back to the same initial level that it was before. That is where certain arbitrage traders do definitely make some pretty good profit. Now, with all this trading going on, let's assume now the total existing liquidity pool that earlier had 10 ETH and 1,000 JET tokens now has reduced to 5 ETH and increased to 2,000 JET tokens respectively. Now, the new pool ratio that you can actually withdraw considering your contribution is 0.5 ETH and 200 JET tokens. Now, taking that and multiplying with the actual value of ETH that is there after the change to 400, you would be getting a dollar value of $400. That's 0.5 into 400 and 200 JED into $1, keeping JED as a constant again, guys. Now, if liquidity was not provided, you would have ideally got, by just selling those tokens at this particular price point, $500. So now your impermanent loss to consider would be $100. Simple? It's not so simple as we think, but this is just for easy calculation that I've shared. Couple of points which you need to consider over here. Your impermanent loss is $100. Yes, one thing that can actually offset this is the rewards themselves that you would receive when you are a liquidity provider. Now, Uniswap actually provides 0.3% of rewards for anyone who is providing liquidity based on the volume of transactions that happen in the market. That is where choosing a liquidity pair becomes very, very important. You choose a liquidity pair which is actually having a high volume of trade. For example, something which ideally goes in with stables themselves. be USDT to USDC, USDT to BUSD, or even ETH to USDT. These kind of pairs are kind of, having a lot of volume of trade. Once you get the idea, providing liquidity for such pairs would ensure that you would get the maximum rewards. Now, considering another scenario, say there is a very good hype around a specific token or a project, and that is particularly launching. At that point of time, you can definitely expect some good amount of volume. Again, do your due diligence before you go ahead and do this. Provide liquidity there, so that since there are a lot of people actually swapping and there is a lot of volume of trade that is actually involved, you might be able to get a good amount of rewards. However, ensure if the token price drops or increases beyond a certain amount of value, then your impermanent loss also increases. Impermanent loss exists even if your token price increases or your token price decreases. Like I mentioned earlier, if you can look, the liquidity pool pairing in terms of the dollar value should always remain a constant. Now, with this constant, you would only be seeing an adjustment in the token ratios that are there in the liquidity pool. Apart from that, you wouldn't be able to get higher value of return by just pulling out the liquidity pool, whatever you had provided earlier. The only way that you can actually get profits is when you have some good volume of trade, and you will be able to receive a substantial amount of rewards as fee, which Uniswap or any other swap or any other third party ecosystem goes ahead and pays to you. That should offset your impermanent loss. Suppose, for example, in the same scenario over here, you would have got $250 as profit or probably as fees for providing liquidity. With that in place and an impermanent loss at $100, you would be still in profit of $150. That is a good outcome. However, there is something that I would like to also show you. If the price increases or decreases, irrespective of that, there will definitely be an impermanent loss. So here is the graph which gives you an indicative of how much percentage change in the price would impact your actual impermanent loss percentages. A 1.25x price change results in a 0.6% loss. Again, these numbers are indicative, though in the real world scenario, they might be subject to many other conditions, so it might change, guys. 1.5x would give you a 2% loss, 3x 13.4, and so on, and 5x would give you a 25% loss. So as and when the price change occurs, be it up or down, it is irrelevant to impermanent loss. It only considers the percentage change in the price, wherein it adjusts the actual token value in the liquidity pool that you are provided. A little complicated. Get an idea with this simple example, I believe. However, there are ways that you can actually mitigate this impermanent loss. The first and most easiest way to actually do that is to provide liquidity with a stable coin, or keep both the stable coins in the liquidity pool themselves, of say USDT to USDC or USDC to DAI or any other stable token that's existing in the market. A liquidity pair of two stable coins would result in the least impermanent loss that you can expect. You would still be benefiting from the volume of trade that occurs. Even while providing stables, you might be not able to get some good amount of profit owing to the actual liquidity pool existing in the market itself. If your share for contribution to the liquidity pool is very less, then the amount of profits that you would receive from this 0.3% fee from Uniswap, or if there is any other percentage fee from any other third party provider, then that again is in minute numbers, unless and until you provide some good substantial amount of liquidity, say in thousands of dollars. I mean, you could definitely try playing around with certain tokens which are there and new to the market, or probably have a high volume or demand. However, the liquidity is quite low. In those scenarios, you could definitely go ahead and pair up and provide some liquidity to earn some substantial income through the swap fees. But please do make note that the price of the token, irrespective of whether it increases or decreases, and the price of the other liquidity pair that you have provided increases or decreases, would definitely impact your impermanent loss. Now, when does this impermanent loss actually become permanent for you? That happens only when you pull out your liquidity. Unless and until you just keep the liquidity running, then the impermanent loss is not realized. Sometimes what happens, if you see that there is a very big drop or a very big increase, say for example, the token immediately shoots up to 5 times its initial price. At that point of time, basis the graph over here, if you pull out your liquidity, then you would be sustaining a 25.5% loss. If you just keep the liquidity then and there running, and provided later on the price drops to say 2x its initial value, then your impermanent loss now would be around 5.7%. That would give you a much better output as compared to the 25% loss that you had to take earlier. Now, one more thing that you can actually do in terms of any new projects that you want to provide liquidity for, what you could ideally do instead of pairing it with ETH, if there is substantial volume of trade that's actually happening, pair it with a stable coin. So that way, one of the token is almost a constant, and the only other price change that occurs is your other token. So even when you're pulling out the liquidity pool, you would be able to still get a lesser amount of impermanent loss. I hope this was helpful for you to understand how liquidity pools work and how impermanent loss occurs. One important point before you actually go ahead and want to be a liquidity provider is to do your calculations properly. By calculations, I mean how much of volume of trade would occur, how much is the existing liquidity pool in the market, and what stable coin or a volatile currency you would like to go ahead and pair your liquidity token with. Considering these three parameters and probably using the Excel sheet calculation that I showed earlier, you could go ahead and try to have a rough estimate of how much your impermanent loss might be basis the price changes that occur. However, these are just indicative calculations. Like I mentioned, the real world scenario is totally different since the trades happen within a second or even a millisecond. In fact, blockchain is getting pretty quick. So ensure that you go ahead and choose your decision wisely. The safest option of earning a passive income would still remain a staking pool. However, if you would like to take the risk, bigger are the rewards in fact, but you need to do so with due diligence. That's it for this video, guys. Thank you so much for watching. Have fun and take care. Meet you in the next one. This is Mr. Aslan signing off. Ciao.